What's up everyone, it's Karthik with Moneyvest. So with Nvidia creating a new record but in the opposite direction, single day most sell-off in the history of any company, down almost $300 billion, getting now investigated and subpoenaed by the Department of Justice for antitrust violations. Markets here absolutely getting crushed and toast. There were no buyers, no bidders, all till the end of the day. We got lots to unpack and lots to discuss. Hope you all are doing great, even after this spike in volatility of a little bit over 25 to as much as 30%, getting back up to over 20 levels. It's going to be a long one, folks. Hope you all enjoyed this video and find it helpful. All I'm asking in return is that you subscribe to the channel and drop a like on this video. Let's see if we can get up to at least 1,000 likes. I'm putting in a lot of hours to bring you guys the best information and the most data-driven analysis and research here on the channel at Moneyvest. So all I'm asking is that you share these videos with your friends and family, other traders, investors. Help us get to 100,000 subscribers by the end of this year. 34% of you guys are not subscribed, so I would really appreciate you guys hitting that subscribe button and also join our community if you want to engage with over thousands of traders and investors globally and get in touch with us and of course engage and have that community feeling where sometimes there's more like therapy sessions because of days like today. Definitely do engage with us. Link's going to be down below. We'd love to have you on board. There's 4 more spots left. My portfolio was down close to $15,000. So let's get started. The drop in Nvidia shares today is the largest ever destruction of market cap. So shares of Nvidia were down over 9.5% today. If you were watching it very closely, I was live a couple times during market open, and there were worries last week after the earnings, but Nvidia shares steadied after nearly a dozen price target boosts from analysts. We did get a lot of price target increases last week, but that would only offer a temporary reprieve as a round of profit taking hit today. And again, the results basically was a decline of $278 billion. That's over $250 billion in market cap loss here for the company. The worst ever market cap wipeout from a single stock in a day. Prior to Nvidia, this famous record was held by Meta, both on the negative and the positive side. And now the negative has gone to Nvidia, with almost a $300 billion sell-off. And this is what the beautiful heat map looks like, with Nvidia down over 9.5%, Apple down 2.7%, Google down almost 4%, Microsoft, Broadcom. So it was really a very, very concentrated tech sell-off, with some other parts of the market like staples, healthcare, utilities doing actually quite well. We'll talk about that later in the video. But this right here is the sell-off. Nvidia down over 9.5%. It's actually quite funny, trading right at $108. That's literally right my strike. That's my put strike on Nvidia at $108. So my contract is actually now in the money because after hours, the stock is down even more. I think over 2% after the report came out from Bloomberg that the Justice Department is now going to be looking into Nvidia closely for the violation of antitrust. And again, that's a pretty big deal for Nvidia because it's a very large company, and we're going to learn more about that as time goes on. But this is another catalyst that is making a bigger problem for Nvidia at the moment. Advanced micro devices down over 7.8%. The entire semiconductor index that we have created on TradingView down over 6.7%. We got Google down a little bit, almost 4%. Netflix down over 3.7%. The entire Magnificent 7 was down 2.5%. So definitely selling off quite aggressively here. And Apple down 2.7%. Microsoft, Meta, Tesla, and Amazon down anywhere from 1.2 to as much as almost 2% on the day. So Nvidia gets a DOJ subpoena in escalating antitrust investigation. So department also sends subpoenas to third parties in case Nvidia has built a dominant position in AI computing. So the US Justice Department sends subpoenas to Nvidia and other companies as it seeks evidence that the chip makers violated antitrust laws and escalation of its investigation into the dominant AI computing provider. So when you got negative catalysts, they actually start coming in one by one. I mean, this is the dirty game that Wall Street likes to play, and this actually perfectly came out after the markets had already closed at 4:24 p.m. And I have no doubt believing that maybe a few people knew about this already. And in anticipation of this catalyst coming out, they were already dumping shares to get rid of it prior to this report getting released. But I'm not going to get into the conspiracy theory here. But this, again, coming out right at the perfect time of Nvidia reporting their earnings, growth rates decelerating. It's actually quite crazy to believe that a company that's still growing at over 75% year over year, earnings in the triple digit, hundreds of billion dollars in revenue on quarterly basis, record revenues, record margins, is still criticized for not growing fast enough. When we already knew that the law of large numbers was going to play a bigger and bigger role, as numbers get bigger and bigger, it becomes more and more difficult and challenging for the company to grow. But nonetheless, that's the world we live in. That's the world of growth stocks. The growth eventually is no longer growing, and growth rates start to taper down, and as a result, company goes through these cycles of people being very, very greedy, very optimistic and very bullish on the stock, and then eventually turning the corner towards not being so optimistic anymore because the growth rate starts to taper off. But this right here, again, is a separate catalyst for the company, resulting in over a 278 big ones. We're talking billions of dollars wipeout in Nvidia. All Magnificent 7 stocks were down, as you can see over here. So everything was selling off anywhere from 10 to as much as 20, 80, 90 billion dollars. And all in all, our very own Magnificent 7 stocks, so technology, saw a wipeout of over $500 billion. We're talking almost $600 billion. Just another day in the office for these companies. And the entire S&P 500 today erased close to $1 trillion. So Magnificent 7 really made up about 57 to as much as 60% of the sell-off that we witnessed on the day today. So $1 trillion sell-off for the S&P, of which $572 billion came from Magnificent 7, of which 27 to 28% came from Nvidia, right? So Nvidia accounting for about a quarter of the sell-off in S&P 500. That is still a very, very big deal for the market. So this right here is our beautiful S&P 500 selling off over $1 trillion on the day, 56% contribution coming from our very own 7 of the top companies, Magnificent 7. And I actually wanted to go over the companies that actually did see inflows. So these are the companies that actually witnessed gains on the day, and there's quite a few, and combined they actually attracted close to $71 billion. Now it's actually quite crazy to think that $71 billion is still significantly less than what we lost on Mag 7. But for these companies, they can actually be a big game changer, because we did witness, these companies go up anywhere from 1 to as much as 2%. Some companies even as much as 3 to as much as 9% over here after gaining just about $1.2 billion. That is Dexcom, right? Actually, that is not Dexcom. That is CCL Industries. So if you really take a look at the overall, industries and the sectors that these companies belong to, you'll very quickly understand where the money's flowing to and how the markets are positioning themselves. We've got United Health, Procter & Gamble, you got PepsiCo, Verizon, Visa, AT&T, Philip Morris, Johnson & Johnson, American Tower, Southern Company. We got Berkshire Hathaway, Coca-Cola, AbbVie, T-Mobile. Then we've got Duke Energy. We got Dexcom, Bristol & Myers. We got the Cigna Group, Colgate. So these are very, very defensive utilities, healthcare, energy, a little bit more staple sectors, right? These are the companies that markets position into when they are getting ready for recession, when they are getting ready to become more defensive. And we have talked about this in our previous videos on the channel, where I've kind of addressed this entire chart of XLK divided by XLU. We've talked about this in a lot of detail, where if you come over to the monthly chart, what you'll witness is a significant amount of underperformance for technology relative to utilities. And that's just one of the ways the market tells us that we are getting a little bit more defensive. This is the underperformance that we have witnessed in the past. And it's not a surprise that we're kind of witnessing that again, because recession fears are elevated. We are seeing high levels of fear in the markets with respect to economic contractions and weakness. The ISM survey this morning did not help the situation. And then, of course, when you tag along the catalyst from Tom Lee, which I broke down early in the morning as well, you're really just adding fuel to the fire for more accelerated sell-off. So this right here was the day, the Dow Jones dropping over 626 points, S&P down over 2%, and the NASDAQ down a little bit over 3%. And, you know, this is real weakness. I really want to address that this right here is what true real weakness looks like. Not the V-shaped recovery, not the dip that's getting bought up very quickly, not the buyers that are stepping in and bidding the markets higher. This is what true weakness looks like. And the reason I say this is because we did not find any support throughout the day. It was just lower highs and lower lows, and we just continue to make new low of days throughout the day. This is what genuine, serious selling looks like. This actually kind of reminds me of 2022, because not only did we make a lower high on the S&P and on the NASDAQ, we actually are on our way, potentially speaking. Again, nothing's confirmed yet because this is just one day. One day does not make a trend, but we are seeing some serious weakness here, because not only the selling pressure was pretty aggressive, right? We're down anywhere from 2 to as much as 3% for the S&P and NASDAQ respectively, but we actually did not find any buyers. There were no buyers ready to bid on any stocks to push them higher. There was very clear rotation out of technology, out of Magnificent Seven, over to more defensive and stable parts of the market. And like I said, this did not help at all, as Tom Lee essentially advises caution, and stocks could fall 7 to 10%. I did a video on this earlier today, but he essentially said that 7 to 10% correction is possible. There is going to be market turbulence, and we need to be ready in the next 8 weeks to buy the dip, buy the correction, buy the pullback in the market. That's exactly one of the reasons why I've also been advocating for raising cash, getting ready, and again, when the opportunity presents itself, take advantage of that sell-off. This right here is where we are in terms of ETFs. Money also flew into fixed income, so we did have the bond market kind of attracting a little bit of liquidity, and that's again one of the things that we have talked about. So this is technology with utilities, but if you come over to S&P with TLT, very similar pattern, almost identical, because this also tells you a little bit of underperformance on S&P 500 with respect to the bond market, and that once again is this the market's way of getting more defensive, and right now we're seeing a little bit of that selling pressure. This particular relative index chart was down over 3.6% on the day, suggesting for once again what the market is getting defensive. They don't want to be risk on right now. And again, we do have the long Labor Day weekend hangover. I mentioned in one of my previous videos that the Tuesday after, the week after, and the month after, markets tend to actually be very weak, because we're kind of combating with the September seasonality, but we're also, fundamentally speaking, very overbought. We're also a little bit more on the expensive side from a valuation perspective. So there's a lot of waves kind of colliding with each other right now when you look at the markets from that perspective. And this right here is the S&P 500's performance after the Labor Day, with a positive percentage, only 27.3%. So we really had a very low probability to be green on the day today anyway. But of course, we did not expect an average median loss of just being about 61 to 84 basis points to accelerate to over 2 to 3% for the markets, thanks to Nvidia and of course the Magnificent Seven stocks. And this right here is the September seasonality, which we have discussed in our previous videos. We're already getting started on the worst footing possible by being down over 2 to 3% already on the first trading day of September. And the crazy part is that it's really just the last few weeks of September that selling pressure accelerates further. It's not the beginning, but in the past, we've also seen the first few weeks be very, very bad for the market, especially if you look at the last 4 years. September 2023, 2022, 2021, and 2020, all 4 years were red for the markets, with an average volatility reading of well over 25 to as much as 30. That was the highest level on the VIX. We just crossed over 20, and the median value is 24.94. Actually, the median value is 20.5. The average value is 24.94. And so for those reasons, I think we have to be very, very careful with what rest of September brings in for the market, because another 4, 5, 6, 7, 8% sell-off in the month of September means double-digit losses for individual stocks. But don't be scared. Don't be afraid of these market sell-offs and volatility spikes, because they create buying opportunities, as I've already addressed and mentioned this time and time again. So that's where we are. This right here is another chart going over the seasonality. And as we've already pointed out, September being one of the worst months with a very low probability for us to see green in the month of September. However, I really want to point your attention to November and December. And that's when the markets actually tend to do really well. Like they're much, much better, significantly better, with a 70 to 75% probability for us to be green, with an average gain of about 2 to as much as 2.5% for the month of November and December as well. So this is where we are. This is the Moneyvest dashboard right now. We're sitting at 3.7 as the Moneyvest index. I sent out a warning suggesting for the Moneyvest index now crossing over 4. So that is something to be cautious about. And well, guess what? 6 hours later, 8 hours later, we're back down under 4, something that we were obviously talking about. Volatility back over 20, so we are in the 65th percentile again. The contango levels dropped down to 6%, with the PCC index at 0.802. Again, fewer stocks are now above their moving averages, so that is also coming down. Market breadth, again, pulling back a little bit, something that we have discussed on the channel before on this chart. This is something that's coming down, so 73% as you can see, a pretty decent pullback, as again, we discussed that in our previous video, and 70.97% for this, and 73.55% for this. So these are indicators that, again, we have discussed on the channel before. And the price earnings multiple coming down to 22.5, 31% concentration still for the Max 7. We're down about 2.5% from all-time highs. And RSI readings now a little bit more neutral to 50. So you can kind of see that we've gone from a red Moneyvest dashboard to a little bit more yellow, right? So yellow means that we are somewhat neutral and we're not really green yet. You know, once we start to hit these levels at green, so for example, as soon as the Moneyvest index comes down to 3, it's going to turn green. As soon as volatility crosses over 30, it's going to turn green. As soon as the drawdown percentage crosses over 5 to 7%, it's going to turn like light green to very, very green. And same thing with the market breadth indicators, the valuation. So these are all color coded, right? So this is going to be a very, very good guide for us when it comes to understanding how favorable or unfavorable the risk reward is in the markets. And right now, it is okay. It is not super favorable, but it's also not very unfavorable. It's coming down, so we're seeing a nice little pullback, right? So a bit of a dip, I should say, because we're still well within 5% of all-time highs. We're only down 2.5% from all-time highs. So we're in a dip, so it's not super favorable just yet. Until they start flashing green, we're not there yet. So I just really want you guys to have patience, relax, let the markets come to us, let the prices come to you. And this right here is the price to sales ratio, which we have also discussed in our previous updates, and how Charlie Beal did a really good job in kind of putting together this chart and suggesting for how expensive the markets really are, trading at almost 3 times their revenue, which is almost 2 times higher than the median average value of 1.56, also suggesting for how expensive the markets really are at this moment. Now, this is the technical dashboard for a lot of individual ETFs and sectors and asset classes. I've also included for Magnificent 7 over here. And what you'll notice is a big shift. It's a big shift in the markets now because Nvidia just blew past its 5, 9, 2150 and 100 SMA. It's actually quite crazy that we're actually trading below all those moving averages with a single drop of 10%. And of course, it's now down over 24%, I think, from its all-time highs. Google, very similar situation. It's very weak, technically speaking, and so is Microsoft. So from a technical perspective, the 3 companies that are really, really struggling right now are Nvidia, Google, and Microsoft. Apple is down below its 5 and its 9 SMA. Then we've got Amazon, which is clear of its 5, 9, and 21 SMA, but really struggling on a more long-term basis because it's mostly traded sideways. And Tesla, it's been a little bit more weird. I mean, short-term trend is okay, still below the 9 SMA, but above the 21 SMA, but below the 50 SMA, but above the 100 and 200 SMA. So the long-term trend is still, I would say, okay, but the shorter to medium-term trend is still very bearish for Tesla. And Meta is good on a long-term basis, 50, 100, 200, solid, but we are showing some weakness here on the shorter time frames. 5 SMA, 9 SMA, and 21 SMA definitely struggling from those price points. Now, there's been some massive shifts from technical perspectives on some individual sectors here. So S&P now back below its 5 and 9 SMA. The NASDAQ just crushed below the 5, the 9, the 21, and the 50. And the same is true for NDX, which is the NASDAQ 100. The Dow Jones, the same as the S&P 500, trading below the 5 and the 9 SMA here. The Russell 2000, same thing, below the 5 and the 9. And we got TLT now getting sold off. Despite the rotation out of equities over to the bond market, we're still below the 5, the 9, and the 21 SMA for TLT. Gold, on the other hand, is now trading below the 5 and the 9. I just want to confirm that here very quickly. So we're going to come over to this chart. I'm going to type in gold. And gold right now just sitting at over just under $2,500 per ounce. It's trading below the 5 and the 9 SMA at the moment. The dollar index, I think this is really what's important here because it's actually now crossed back above its 5 and its 9 SMA. So there's a little bit of that technical rebound for the dollar index, which has seemed to have formed a bottom. That's really what's spooking a lot of investors in the first place as well, because dollar weakness means strength in equities, and the vice versa is also true. However, it's still well below its 21, 50, 100, and 200 SMA. So if it kind of takes out those moving averages, it can actually be more problematic and more troubling for S&P 500. Now, few sectors I really want to highlight in green, and those are going to be utilities, staples. So 1, 2, and then few more over here, financials, real estate, and then healthcare. And remember I showed you guys the charts earlier of the actual stocks that actually saw gains today. A lot of them, almost all of them, kind of fall in that category. A lot of them actually fall in these sectors, right? We're talking staples, utilities, financials, and healthcare, right? So all the companies, PepsiCo, Johnson & Johnson, Procter & Gamble, Coca-Cola, all those companies fall in those sectors. And they're the ones that are actually green across the board. And they're actually hitting new all-time highs, believe it or not. If you come over to XLU, look at that, almost near all-time highs. XLP, gain all the day, 70 basis points. XLF, also near all-time highs, trading well above their moving averages. Energy is the only sector that actually struggled a little bit, but coming over to real estate, XLRE, up over 23 basis points, also almost hitting a new all-time high. Energy struggled a little bit, definitely saw some weakness, down about 2.5% because of the pullback in oil. But those are the 4 or 5 sectors that I really want to point your attention to, because those are the sectors where the money and the liquidity and everything is kind of flooding into right now. And then we've, of course, got energy struggling a little bit, industrial and materials also down on a more short-term basis, but they're still actually quite strong. So if you come over to XLI, again, today was a drop of 2.2%, but we are pretty much trading near all-time highs. It's really only down about 2% from all-time highs, and same thing is true for materials. XLB, up until Friday, it was at near all-time highs, just down about 2.2% on the day today. So short-term, yes, there's definitely weakness here, but over the longer term, still doing really well. So it's really just technology sucking a lot of liquidity out, and a lot of that is going into utilities, financials, staples, real estate, industrials, materials, energy, all those parts of the market. So this is all these sectors. Performance, staples and real estate doing really well. And this is actually year to date. And to my surprise, financials is actually leading 21% higher on the year, followed by utilities, 20% higher. You'd think technology is having a great year. It's actually not even in the top 5. It is. XLK is right over there, 10.72%. Technology is actually lagging pretty significantly this year. I mean, we've got financials, utilities up 20% each. Then we got comm services, which I guess you can make a case for Meta and Google and being in there. Then we got consumer staples. That's the 4th most promising sector year to date, up almost 16%. We got healthcare, 15.3%. Industrial, 13.5%, and then comes technology, up over 10.7%. So it's really not even in the top 6 if you consider year-to-date gains. And this is just, again, market's way of getting very, very defensive, right? This is supposed to be a D. A D. I'm going to give up here. So defensive is what the market's positioning is right now. So when it comes to all the economic data, we do have Joel's numbers coming out tomorrow, Wednesday, September 4th, and of course the Beige Book as well. And that is going to be very, very telling for the market. If job openings continue to come down, that is not going to be a good look from a recession outlook perspective. And again, employment situation later this week on Friday is going to tell us a little bit more about where the unemployment rate is, unemployed persons, all that stuff. FOMC in 16 days. Joel's numbers consensus 8.1 million. PMI composite also coming out tomorrow, I believe. Yep. So actually the day after, so Thursday, September 5th, and the consensus 54.1. Markets obviously do not like the ISM manufacturing index, and this right here is the employment situation. 4.2% is what the market's pricing in right now. That's the consensus, down from 4.3, which is the prior number. And we are still very much baked into a 25 basis point cut. And as we already know, a history of the Federal Reserve cuts here, if it's accompanied with a recession. If the Federal Reserve rate cut cycle is accompanied with a recession, we tend to see significantly bigger losses for the market, bigger drawdowns for the market, and they're much longer lasting, as opposed to the times when the markets are not seeing a recession, right? Rate cuts not accompanied with a recession, those drawdowns are well contained within 7% or 10%. And of course, we do tend to see stronger recoveries for the markets as well. So really the question is going to come down to whether we see a recession or not. And this right here, again, showing us the performance. And it was really October, the month that we had to be worrying about. Of course, September seasonality is still strong, but October, the record is even worse with only 4 times we've actually been higher. And 19 times the markets have been down by an average and median of about 2.5% between these two dates, October 18th to October 28th, that 10-day period. And this is after we get a plus 5% summer, which is July through August, which is what we had this year in 2024. So August 18th to 28th, also a very important time for us to keep in mind that markets have a very bad track record in and around those levels. Now, coming over to gold, I think it's really underrated because UBS, Goldman, and Bank of America, they're all pushing gold. This actually came out earlier today. And they essentially see Bank of America says commodities are the best place to be until 2030. This is quite interesting report because they're not talking about the next year or 2 years for hedging purposes. They believe that this is the beginning of a new bull market in commodities where they're expecting significant upside for gold and silver. So commodity bull market is just starting, and Bank of America strategist Jared Woodard is expected to see a steep rise in inflation for the foreseeable future. Inflation has remained at the Fed's target of around 2% for 2 decades until recent years, and a trend that could soon revert to trends seen before the 2000s when prices rose at an average of about 5%. And in that environment, the bank expects commodities to generate an annualized rate of return of about 11% as debt, deficits, and demographics, reverse globalization, AI, and net zero policies are all inflationary. And the report recommends investors consider a 40% allocation of commodities over bonds given the global economic climate. And gold and silver have been some of the top performers in commodities this year, though there have been underperforming assets such as crude oil, which have been trading at similar levels from 2 years ago. And they said the commodity bull market is just getting started. So Goldman says, go for gold. In a Monday note titled, Go for Gold, Goldman says it revised its $2,700 an ounce call for gold to happen by early 2025 instead of the previously predicted end of 2024. And price-sensitive China market as one of the top reasons for the revision, but also said the metal has a strong future for the same reason. So that's what they are essentially expecting. And UBS also noted that the expected drop in the Federal Reserve funds rate will likely be bullish for gold, as the precious metal has seen about an average of 9% gains over the first 2 quarters following a rate cut. So everyone is getting pretty bullish on gold. I've been talking about this for quite some time, and it's actually quite funny because we did get a comment from one of our previous videos suggesting for gold being one of the worst investments, when in my opinion, I think it's done really well. It's kind of stood the test of time. It's held up really well, and there's absolutely no problem for me to diversify a little bit into gold, whether it's 4, 5, 7, 8% of my net worth. If I'm buying gold a little bit, it's just a way of store of value. It's got actual real tangible value. It's very liquid. And I really don't mind holding on to gold in times of during, if there's a recession or if there's any type of crisis, gold actually tends to perform much better. So that's something to keep in mind. And this right here was another really interesting chart from Bar Chart, suggesting from all-time high, 464,000 Americans are now working 2 full-time jobs. And this number just hit its highest level ever, going back as far as 1995. And that is really just suggesting for how the economy is not as strong as what many economists or people or investors believe it to be. And if that weakness starts to really show up in the data, unemployment starts to accelerate, delinquencies start to increase, credit card debt continues to increase based on high credit card interest rates, then that is really going to be problematic for the economy, which is eventually going to be problematic for the Federal Reserve. And the Fed is really praying that by the time unemployment really gets out of hand, if it does, inflation is back down to their target of 2%, at best lower, because if it isn't, then they're really stuck between a hard place, a rock and a hard place. That's where they're going to be, because they're going to then fight between their dual mandate. One of them is to lower interest rates to help support the economy and lower unemployment. The other one's going to be to raise interest rates to help fight inflation and not let prices get out of control. So they're going to be stuck fighting between their own dual mandate and which one to focus on if unemployment accelerates before, more aggressively, by the time inflation comes down. So they're really hoping and praying that by the time that happens, inflation's already back down to their target. We'll find out in the next few months what ends up happening with inflation. Now, dollar gains for fifth day as the U.S. traders return from holiday, and this is also something that we have discussed, that the dollar index definitely causing a bit of problem for the equity market. So if you come over to the daily time frame, we talked about how this is being a very, very strong support. Is this the bottom? Is this the bounce for the dollar? Of course, time will tell, but this is definitely not, showing a lot of promise for the S&P 500, because we are now at a very critical support, and any type of bounce back higher from these levels, as we've already witnessed here once, twice, 3 times, 4 times. So any type of bounce back higher for the dollar index is not going to be great for the S&P 500. So that's something to keep in mind. Now, coming over to volatility, 20.71. So that is up over 33% here on the day, as we've already discussed. As the VIX goes high, it's time to buy. Risk reward still okay, not super favorable at the moment. So I'm going to allow for the markets to play out for the next few days here, and really start deploying capital once again towards the end of this week, or perhaps even going into next week after we take a look at the unemployment numbers that come out this Friday. So wait patiently, let the markets come to you, let the prices come to you, let the volatility spike a little bit further. If there is going to be some more recession fears, that's going to create more weakness, more pain in the markets, and that's when we start to deploy more capital intelligently in individual stocks or ETFs or whatever it is that we want to buy high quality at our desired prices. So that's going to be the strategy moving forward. And volatility right now, just over 20. Next target, 23 to as much as 36. We'll find out if we actually see those levels once again from the VIX or not. Again, 65 was the level from back on Monday, August 5th. Oil prices breaking down quite aggressively here, below $70 a barrel. So we're down about 5% right now. And this actually helps inflation, so that's a good thing. And next support is going to be down over here as low as 66 to as much as $67 per barrel for crude oil. And Bitcoin here consolidating sideways, still well within the downtrending channel here of lower highs and lower lows. And this right here is going to be actually a resistance for Bitcoin that's going to sit roughly at 62,000. And support level is going to stay put down here inside this green rectangle for Bitcoin as well. Now, coming over to the markets, unfortunately, we got a breakdown. So I hate to break it to you, but the bulls actually lost today in quite very dramatic fashion, because the S&P down over 2%, about 120 points. We were not able to hold up that support for too long. We came down here, retested once, retested twice, retested 3 times, 4 times, but eventually we kind of gave in. And this right here was the support that we were talking about, right? That was a area of consolidation. So if you really take a look at how the S&P has been trading since August 19th, it's really been like this, right? It's been flat, consolidating sideways. And then eventually what happened is this was the breakdown, and we sold off further. As you can see that we're, at one point we were trading on 5,500 and got a little bit of that rebound towards the close. But unfortunately, I'll go ahead and turn this level into a resistance now for S&P 500. So a little bit of a dead cat bounce is possible. I want to be very clear. I think a dead cat bounce or a bit of a technical rebound is possible because today's selling pressure was quite exhausting for the markets, in my opinion. $1 trillion loss is not something small. So would not be surprised if we do get a little bit of that rebound back up to this resistance, a little bit of retest, that all support potentially acting as a resistance, and then of course a bigger leg down on the back of maybe some more elevated recession fears, September seasonality, unemployment rate, the Federal Reserve decision and inflation numbers coming out next week. So there's a lot on deck for the markets in the coming weeks here. So that is going to be the game plan moving forward. But all of that is going to create buying opportunities. I really want you to remember that a lot of that is going to create opportunities for us to dollar cost average more aggressively and buy into the market. So that's where we are. Very strong resistance now sitting at 55.65. And next support for me is going to stay put down to 5,400 for S&P 500. A 7 to 10% correction, as what Tom Lee's mentioned, is going to put us roughly around 52.55 to as much as 5,200. Actually, you know what? I posted this in our Discord as well. Let me just bring that over very quickly. But this right here is what I sent over in our Discord. This is what Tom Lee essentially mentioned. He said that we see a flat to down September to election day. And then the markets rally with S&P 500 rising to 5,800. But that is post-election. So they see a flat to down September all the way through election. And then post-election, they see the markets rising up to 5,800. But the risk is a move to 5,200 to 5,300 first. So they actually see 5,200, 5,300 first. And then September, again, that's the risk that would come down to that level. And then post-election, getting up to 5,800. So keeping that in mind, 52, 5,300 is going to put us roughly around here in this range. And then, of course, getting up to 5,800 is a nice 8 to 10% rally back up to all-time highs. So that is still very much a possibility for the markets. And now coming over to QQQs, again, the bulls were not able to hold up these levels. We broke down fairly quickly below the 468, 469 level. And the next support is going to be down here at 454. And we're going to go ahead and turn this level into a resistance now. Unfortunately, it's going to stay put at 468, 469 for the NASDAQ. So that's going to be a level to keep in mind for QQQs. Now coming over to individual stocks. So for example, Apple here selling off, as we had already discussed, coming up to very overbought levels. You can see the RSI, the MACD was extremely overbought. So today was a decent sell-off after hours, down another 77 basis points, and the next support really is going to stay put down to low 200s again. So $207 with the RSI, MACD, and of course the L3 banker oscillator also showing weakness for Apple at the moment. Amazon, on the other hand, also down about 1.2%. Support level is going to stay put at 173. So this right here is going to be that level to keep in mind. A little bit of a potential head and shoulders there. Then we broke down significantly during the sell-off from the carry trade, recovered back up, and right now that's going to be that support at 173. Talking about Nvidia, one single day down to $108 after hours, down another 2%. So a lot of weakness for Nvidia coming in, and next support is going to be down at $96. Unfortunately, that's going to be the level. It's most likely that I'm going to get assigned about 600 shares of Nvidia at the market close on Friday. Depending on where Nvidia is trading, I'm actually planning on rolling out my options a little bit. So we'll see how Nvidia trades tomorrow and later this week. So accordingly, I will plan and send out all the alerts in our Discord. Again, if you want to get access, link's going to be down below. But next support is going to be down at $96 for Nvidia. We had discussed how the RSI, the MACD, the L3 banker oscillator, everything was getting very overextended and overbought. So it's not a surprise that we are seeing a bit of a pullback and quite a significant correction for Nvidia right now. And again, a lot of negative catalysts just keep on piling over. Advanced micro devices, huge breakdown below 142. Next support is going to be down at 122 here. Apparently, they have snagged an AI expert from Nvidia to join them. So reports that AMD Executive Vice President and Chief Technology Officer Mark Papermaster is going to be joining the company to expand their ecosystem for artificial intelligence. So next support for AMD is going to be down at 122. We're going to go ahead and turn this level into a resistance for advanced micro devices at $142. Coming over to Tesla, and Tesla here also down about 1.6%. It was showing a lot of strength at some point in the day, but then finally caved in. It was like, I can't do this alone because it was the only stock that was green at one point. So support level is going to stay up roughly at $208 a share for Tesla. Coming over to Meta Platforms, and Meta here also selling off, as we had already discussed. Coming up to its area of resistance. Not a surprise that it's starting to see a bit of a pullback, considering how overbought and overextended the RSI, the MACD, and all these other indicators were. So next support is going to be down at $458. Finally, coming over to Google, brutal sell-off. We discussed the bear flag, and that's exactly what played out here. Paul got a bear flag, and now we're seeing a breakdown here for Google. Next support really is going to be down in the 150s here for Google. Would not be surprised if we actually end up in the 150s. The juicy premiums are going to be starting to play a bigger and bigger role, and I'll be looking at selling puts on Google as well. Talking about Microsoft, same story. It is still in this head and shoulders pattern. So this right here, left shoulder, head, and a right shoulder. And if you do end up, let's see, breaking down below this neckline, I wouldn't be surprised if Microsoft is actually sub $400 as well moving forward after breaking down from this potential head and shoulders here. Talking a little bit about PayPal and Visa. So coming over here, PayPal actually doing much better than a lot of its peers. Just down about 0.5%, so a little bit of outperformance compared to the S&P 500 and NASDAQ here. Support level is going to stay put right over here at $70, with a resistance all the way up to $76, $77. It is overbought right now. So on the RSI, MACD, quite extensive on the RSI MACD here, so very, very overbought at the moment. It's just got to be very careful. Visa did see some inflows, as we discussed. Very nice performance, up over 79 basis points. However, coming up to overbought levels, RSI at over 70, and MACD also pushing higher, and the next target and resistance stays put at $282, with a very strong support sitting right here in the 270s for Visa. And finally, coming over to Enphase and Costco. Enphase here selling off down about 6%. Next support is going to be down here at close to $97, $98 per share. Again, RSI at MACD showing signs of weakness. And Enphase also just consolidating sideways in that range for a really long time. So this right here has been the range within which Enphase has been trading for a really, really long time. And then finally, Costco here also pulling back down about 1.5%. Support level is going to stay put at $872 down to $839 to as much as $785 for Costco as well. RSI MACD also rolling over for this company. And finally, we come over to Netflix, NFLX, also rolling over. Again, it was at a resistance, as we had discussed, at $700 a share, and support level is going to stay put at $661 down to this higher low in the 620s. Not to mention the RSI, the MACD, and the L3 banker oscillator showing a lot of weakness for Netflix as well. So hope you all enjoy this video, and a very, very long update. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. And as always, happy investing. I'll see you all in the next video.